All right, here's one I want to spend a little bit of time on, this new pass-through deduction. So we talked briefly about the corporate tax rates for C corporations. Congress said, okay, if we're going to help out C corporations, then we need to do something for other types of corporations, pass-through type entities, which is really what probably a lot of you in here that are business owners are probably using a pass-through entity. Most what we call Main Street, since we're on Main Street, let's call them Main Street companies are typically organized as pass-throughs versus larger corporations tend to be the C Corps. This is for mostly smaller companies. So in the past, didn't exist, no deduction. Now, under the new law, you've got a 20% deduction. It's eligible, the eligible entities are S corporations, partnerships, and sole proprietorships. All right, there's a lot of rules and regulations surrounding this, but at its basic level, the qualified business income from a trade or business means you're actually operating a business. You get a 20% deduction straight off the top. It's pretty simple. So where the complexity comes in, though, is when there's some limitations on this based on your income. All right, so I'll talk about that in a minute. And one thing to note is this is not, in no case is there anything, is this eligible, or any kind of wages that are being paid to you are never eligible for this deduction. All right, so that's never a situation where you can take this. It's only, excuse me, it's only what we call pass-through income, mainly what you get on a K-1 or on a Schedule C.
Do you have the income threshold?
Yes, sir, I'm going to talk about, I'm talking about that in just a second. Yes, sir. Next slide, here you go. All right, so I said it was simple, but that's only if your income, if you're single, is below 157.5, and if you're married, 315,000. If you're below that, pretty straightforward. And if you're above that, it gets more complicated. So let's talk about some of the complexities here. All right, if you are over these income limits, and these income limits apply to your entire tax group. Like if you're married and filing joint, it's both spouses' income. It's everything. So it's all your income, all your wages, all your business income. And you add them all up, and if it's over these limits, then these new rules apply. All right, so if you're over these limits, the first limit, or the first exclusion is your business, your qualified business income cannot be from a specified service, trade, or business. All right, and you can see here the list. It catches a bunch of us in this room: law, medicine, accounting, consulting, investment services. For some reason, they carved out a specific exception for architecture and engineering. I'm not sure how they did that. Maybe good lobbyists or something, but they somehow carved that out as an exception. So they must have spent some money on the lobbyists. But anyways, if you're in one of those business and you're in business lines, industries, and your income is above that amount, sorry, you don't get to take this deduction on your flow-through income. The second item is, let's say, okay, you got the income over the amount. You're not in one of those trade or businesses. You're in something else like manufacturing or hospitality or something like that. You're only allowed to take the deduction if your business has W-2 wages and or tangible property. Now, if you think about the types of businesses that are not on that list, again, think about a manufacturing facility. You're going to have employees, and you're going to have a lot of property that's on your books, because what you have to, you got to have machinery and equipment and people to run those machines and equipment if you're going to manufacture something. So most likely, I think this is not going to affect too many folks, but it is still a calculation that needs to be done. And I think we've got to look at it and plan for it. Now, there is a phase-out range once you get above these income amounts, and it's $50,000 for single and $100,000 for married. So really, the actual phase-out is what 207.5 and 415 is the true phase-out, or the true zero amounts. But it does phase out as your income gets above those amounts. Now, this is one area we do have some new updates. So what I previously told you was all in the 2017 tax reform bill. This new item, or these new updates, came about in August of 2018. So, what is a specified service, trade, or business? We had the list that we looked at that had things like law and accounting and investments and things like the medicine, things like that. But what does that actually mean? How do you actually, in detail, how do you actually define those businesses? And what about kind of fringe businesses that are kind of in that industry but not necessarily in that industry? Well, this new law basically clarifies some of that. So one of the items, and I've got an article that goes into a lot more detail about this, that if you'd like a copy, and we can send that out to everybody, it really lists out and dives deep into what's included here. But one of the examples they gave is, for instance, on that list you saw medicine. All right, so for instance, if you're operating a medical practice, and say it's a GP practice, something like that, family practice, that kind of thing, you're not going to qualify. But what does qualify is things that you might consider healthcare, like running a physical therapy type of a practice, or a health club or a spa, things like that. Those types of companies probably will qualify, most likely. And there's some rules and regulations that talk specifically about that and say, things like medical testing or medical research, that qualifies. But you kind of say, well, that's not really a medical practice, but they just wanted to clarify it in the rules to make sure you knew that's going to qualify and it's not excluded just because it's related to medicine. Also, the second item there, you see providing services to a specified service, trade, or business does not automatically disqualify your business. So let's say you own rental property, because rental activities are likely going to be qualified for this. It looks, from what we've seen, it looks like they are qualified for this deduction. Let's say you're renting property to a medical practice or to a law practice or to an accounting practice. That does not disqualify you just because you're doing business with a disqualified type of business, all right? Or if you're providing other types of services to someone who's disqualified. One positive thing that we saw through these new updates is ancillary consulting. So for instance, something related to consulting that has to do with equipment manufacturing or equipment installation or something like that. If it's kind of an ancillary thing where we're installing equipment or we're doing something physical that involves goods or merchandise, but we're providing a little bit of consulting on the side, trying to help you out, provide good customer service, that's not going to eliminate you from being able to take this deduction. So that's a good feature. I think that's a good thing. And the only caveat to that is generally you're only going to allow that, or not going to be disqualified, as long as you don't have a separate line item on your invoice for the consulting services. All right. Now, I don't think that is talking about labor. I think that's specifically saying, you're consulting. You're actually doing consulting, and it's a specific, maybe an hourly type thing or something like that. So as long as it's not done that way and it's just kind of lumped in and with the price of the equipment or the installation fee, I think you're going to be okay. Hybrid businesses, there's an exception that was put into the regulations. So if you have a business that is clearly doing both a not allowed business and an allowed business, well, if you meet these exceptions, under 25 million of revenue, if the not allowed portion is under 10% of your gross receipts, you're good. It's kind of a safe harbor. De minimis rule. If you're over 25 million, as long as no more than 5% of your gross receipts is the disallowed activity, then you're in good shape too. And you can take the deduction on the whole amount. Now, very interesting development, I thought, one of the most interesting things I read in this new regulation is that there's a phrase at the end of the rule that says, any business, let me see if I had it on here or not. I don't think I did, okay. Well, it's talking about you're disqualified if you're one of those industries, or if the reputation or skill of one or more of your employees is the primary product or the primary reason that people do business with you. Okay, and so when we saw that initially, a lot of commentators were thinking that's going to disqualify a lot of Main Street type businesses. Think about actually an example they gave in the regulations was a bicycle shop. Maybe a high-end bicycle shop where you've got someone who's been in the business for 30 years. They know everything there is to know about bicycles. And you go to that person, they're able to fit you with the perfect bicycle and the perfect accessories, and they're providing a lot of consulting and a lot of advice to you. Well, you've gone to that person because you know their reputation in the community is really good, and you know that they will do a good job for you and provide you the best service and the best quality of products. Well, the IRS says that's okay. That actually does not disqualify that bike shop from taking the pass-through deduction, which I thought was really interesting. What they said does disqualify you in terms of reputation and skill is primarily they focused on celebrities. So I thought that was really an interesting thing. It's very, I think, taxpayer friendly, at least for us common folks who are not celebrities, that basically if you're not, unless you're getting paid to endorse a product or paid to appear at a grand opening or something like that, or whatever it is you're doing, or you're in a commercial or something like that, unless you're doing one of those things, then you're okay in terms of that one test. Now, it doesn't mean you won't be disqualified for other reasons, but a really, again, a good example that they brought up in the regulations is, think about a celebrity chef, you know, someone like a Bobby Flay or someone like that. There's multiple tiers or multiple, you know, sections of their business. They actually, a lot of those guys run restaurants, you know. They have usually very successful restaurants, maybe in big cities and very high rent districts, because they know they can generate a lot of volume. So they've got very profitable restaurants, but then they also, of course, they're celebrities. They may have a line of cookware, they may have a line of consulting services, they may appear to, you know, I think Alton Brown does all the kind of commercials for grape juice and all these kind of things. Those kind of things, of course, are not going to qualify. But just because you're doing those things, it doesn't disqualify the restaurant side and the actual business that you're running, or if that person happens to own, you know, a piece of a manufacturing company or some other type of company that does qualify. So just because you're a celebrity doesn't disqualify your other lines of businesses. So I thought it was good too. So again, very taxpayer friendly, and it really makes you think you need to, if you're working with someone who's a celebrity, or you have a client or someone as a tax preparer, if we have a client who's a celebrity, we need to look at that and make sure those lines of businesses are separated out. All right, a couple other things the updates did. It clarified the wage calculations, as I mentioned before, that if you're above those income thresholds, you do have to do some wage calculations to determine how much deduction you can get. It kind of clarified that, and that's very technical. I won't go into that today. But another interesting development was that immediately when we saw this deduction was available, we started thinking about a lot of our clients that have multiple pass-through entities. So if you've got one business you're running, okay, it's nice and clean. You got income, you take the deduction if you're eligible. But what if you've got one business that makes money and one business that loses money? And maybe the business that makes money doesn't really have a lot of wages and property, but the business that loses money does have all the wages and property that would make you eligible for the deduction. Well, these regulations clarified that you will be able to kind of consolidate those things and aggregate those things and put all that together. Again, a lot more technical than I need to go into today, but just to know that is available. And if you've got multiple pass-through entities, there is some leeway and some flexibility to be able to combine those items and combine those elements.